In the world of futures trading, a common strategy employed by large financial institutions or sophisticated investors is the practice of what's called iceberg ordering. This type of order could be done in the accumulation or distribution phases and is often conducted by sophisticated investors. How do they achieve this iceberg ordering? Let's talk a little bit about these iceberg orders. They could have significant impact on the price action and often lead new investors to making irrational decisions that end up going against them. It is also important to know that even if you are a range-bound trader or a swing trader, understanding these types of orders can help you reduce your risk and avoid making bad trading decisions. What is an iceberg order? An iceberg order refers to the practice where a large investor, such as some institutional players, hides their full order size and avoids substantial market disruption. This strategy gets the name from the idea that the visible portion of the order is just like the tip of an iceberg, the vast majority of the order hidden below the surface. This process often manifests in the price action as follows. A large institution needs to purchase a considerable number of Nasdaq E-mini futures contracts. If they place their entire order at once, this could considerably affect the market supply and demand balance, causing a significant shift in the price action. To avoid driving up the price and thus spending more, or pushing down the price and getting a worse price for their orders or contracts, the institution instead breaks up the large orders into smaller pieces, placing these orders over an extended period of time. This way, they do not show up to the untrained eye, and these institutional investors could get a fill without negatively affecting the price. By distributing these smaller orders across a day or even several weeks, these institutions' activities become less noticeable in the price action. This strategy prevents significant price spikes that might occur if the full order size were known to the general market. The same strategy applies when the institution needs to sell a large number of futures contracts. It is essential to note that while this strategy might effectively mask large orders, keen market participants might still notice consistent buying or selling pressure in the price action and adjust their strategies accordingly. This makes understanding the concept of iceberging orders a crucial skill for swing traders, as it could influence their trading decisions, allow them to take less risks, or have better trading outcomes. Furthermore, while the iceberg strategy is common and legal, it is vital to differentiate it from market manipulation practices like spoofing, where a trader places an order with no intent of executing them, creating false market signals. These practices are illegal and monitored by market regulators. For day traders, it is important to remember that price action in the Nasdaq E-mini futures contract markets is influenced by various factors, including the broader market sentiment, macroeconomic data, geopolitical events, among others. Thus, for day traders, a comprehensive understanding of these dynamics is key to developing an effective swing trading strategies. Or, if you're a range trader, that will also help you make better decisions and avoid taking unnecessary risks. Volume interpretation in Nasdaq E-mini futures, a price action analysis. When it comes to futures trading, one of the key contracts of interest in the E-mini, which tracks the Nasdaq index, swing trading. These futures contracts require an in-depth understanding of the price action. as well as the role of different market participants and the various strategies they employ. Among these, iceberg order strategy is one that has the potential to greatly influence the volume and price action. We've previously discussed what iceberg orders are and how they are achieved. Let's briefly expand on that a little bit. An iceberg order is a strategy used by large market players to disguise their true intentions. Like an iceberg, only a small portion of their total order is visible, while the bulk remains hidden, hence the name. When these orders are executed, the true volume of trading can be obscured, creating a perception in the price action that the volume is lower than it actually is. This is because the iceberg order is broken into smaller lots that are progressively executed. Understanding the impact of iceberg orders is crucial for swing traders working with the Nasdaq E-mini futures contracts. This perceived volume might indicate lower trading activity, while in reality, a large player might actively be executing an iceberg order. Traders who do not recognize this could misunderstand the volume data, potentially missing vital signals about the market direction. For instance, unusual surges in volume visible in the price action usually signifies strong investor interest and could indicate the beginning of a new trend. However, if this volume surge is the result of an iceberg order, it's primarily the activity of a single player, not a consensus among multiple investors. This could lead traders to draw inaccurate conclusions about market and its likely direction. Incorporating the understanding of iceberg orders into swing trading strategies can help traders more accurately interpret volume data and make better informed trading decisions. It is important to remember, though, that volume is just one aspect of the market dynamics, and successful trading strategies typically incorporate other tools and possibly some indicators as well. Recognizing iceberg orders in price action is a complex skill requiring a sophisticated understanding of the market mechanics and thorough analysis. As with all trading strategies, it is important to consider multiple influences on the market and not to rely solely on a single indicator or set of data. Price action essentials in Nasdaq E-mini futures swing trading. In the context of trading Nasdaq E-mini futures contracts, swing traders must be cognizant of a myriad of factors that influence the price action. Among these, understanding the strategies of large market participants and the things they use, such as iceberg orders, can provide some valuable insights. However, trying to actively detect and trade based on these strategies might not be the most effective use of a day trader's resources for several reasons. These things could be resource intensive. You could also misinterpret the risk. They are unpredictable. Using focus, as well as legal and ethical considerations. Let's talk about the resource intensity. To identify iceberg orders, one would need significant computational power, complex algorithms, and extensive market data. Most individual traders lack these resources. Large institutions usually use advanced software and algorithms to implement these iceberging orders, making it more challenging for individual traders to keep up. Let's talk about risk of misinterpretation, because attempting to spot iceberg orders can lead to false signals and misunderstandings. The hidden nature of these orders mean it is easy to underestimate their full size and their impacts on the market. leading to unexpected price action and potential losses. Therefore, day traders should avoid spending time trying to identify iceberging orders and spend time learning price action and how to speculate market direction more effectively. Let's talk about the unpredictability. Even if an iceberging order is correctly identified, predicting how the market will react to one once the entire order has been executed is another challenge. Market movements are the results of many factors, not just the activities of one large market player. Swing traders typically excel by developing and sticking to a trading plan based on their own strategies and signals. Hunting for hidden iceberg orders can divert attention from this focus, leading to decisions based on speculation rather than sound analysis. Therefore, as day traders, we should focus on our price action trading and not try to figure out what the market is doing or who is doing something in the market. That is irrelevant to us. Another thing to consider is the legal and ethical considerations. There are ethical considerations around trying to identify and trade based on hidden orders or the orders of others. In some jurisdictions, this could potentially fall afoul of the law, and you could possibly spend time in jail. Therefore, you should be careful. Given these factors, swing traders dealing with the Nasdaq E-mini futures contracts or any other instruments would generally be better served concentrating on refining their own trading strategies and understanding the broader market dynamics rather than trying to hunt for iceberging orders.